Alright, welcome to another video on how to secure yourself financially. So here what I'm going to do is to jump straight forward to the beginner guide to financial statement, where in these sections from the sec.gov, the Security Exchange Commission, so they explain is what financial statement do. They show you the money. Everybody can learn about the basic part of financial statement and how to read them. If you're able to read a nutritional label or a baseball or soccer box score, you can learn to read the basic part of financial statement. And if you can learn, or if you know how to apply it for a loan or follow a recipe, you can learn the basic of accounting. And the basic, they're difficult. So after all, financial statement, they show you the money. And we have four financial statements: balance sheet, income statement, cash flow statement, and the statement of the shareholder. So the first show what a company owns and what it owns at a fixed point in time. The income statements, how much money a company made and spent over a period of time. The cash flow, that show is the exchange in money between the company and the outside world, as well as the statement of the shareholders, that show change in interest of the shareholders over time. Sorry. So here, in this section, they just only focus is on the first three. Balance sheet, the TLDR of this is generally sorry. A balance sheet is a snapshot of the company assets, liabilities, and shareholders' equity, where assets are anything that a company owns that has value, whether it's tangible or intangible. Liabilities, which are responsibilities or obligations that a company has to pay, whether it's for their vendors, creditors, investors, customers. And the statement of the shareholders' equity, we show is the money that will be left over if hypothetically the company decide to, or for some reason, if a company decide to sell off all of their investment or sold all of its assets and pay off all its liabilities. So the leftover money belongs to the shareholders. And this statement is generally listed following is a formula, or is listed following a formula. Assets are equal to liabilities and the shareholders' equity, where you can find that in that layout, or you can find in another format like all the assets listed at the top, followed by the liabilities and the shareholders' equity. So these are generally listed, the assets, based on how quickly they can be converted into cash, whether it is current assets that can be converted into cash within a year or less. So for example, we have here things like inventory or non-current assets, things that will take longer than a year to convert into cash, and fixed assets, assets that a company that are not for sale. Assets that are not for sale because it allows to business to run. Liabilities, generally listed based on their due date. So you have current liabilities, which are obligations that a company has to pay off within a year, and long-term liabilities, more than a year. And the equity or the shareholders' equity, which is where in the shareholders' equity it shows the amount of the investors, uh, the amount of the so is the amount invested by the owners of the company plus or minus revenue or losses since inception. So then I look at the income statement, which the bottom line of this statement show you if a company made a profit or not. So the sec.gov here in this section, they explain you that you can think of this as a set of stairs that you start at the top, and every time you go down the stair, you make a deduction associated with that revenue. And the bottom or at the bottom of the stair, now you know if a company made a profit or not. So generally, this income statement show you at the first the total amount of revenue, and then once you go one step down the stairs, you make a deduction from merchandise returns or merchandise returns and discount. All right, so you reach to the net revenue. Once you go down the stair one step, you deduct is the cost of sale, meaning is how much money a company spend to produce the good and service over a period of time. So you reach to the gross profit, and right after that you make deductions with the operating expense that a company incur for its daily activities, such as administrative salaries, marketing, developing new products or improving existing ones. Also, you deduct things like depreciation and amortization, and right after that you reach to the net income before or net income after, operating expense or gross profits after operating expense. Okay, and then here is when you do in fact is they call income from operations, right? Or operating profits before interest and income taxes. This is also called as incomes from operations. So once you deduct things like the interest, for example, is money that a company borrow and lend, okay, that effect is the income statement, and ultimately you deduct is the income taxes payable, or you add that depending on the use case. Then you reach at the net income, right? So then I also look at the cash flow statement, where this report is the company inflow and outflow of cash, where here it reviews information from the balance sheets and the income statements, and it's important that the company have cash on hand because for things like purchase assets or pay this expense, they need that. So this statement is generally made of three parts, where the cash flow is reviewed from one of these activities: the operating, investing and financing. So it focuses on the operating activities, which is what it does is analyze the net income from the uh, income statements and conciliate with the total amount of cash that was used or perceived from other operating or from operating activities. The most common operating activities we have is operating assets and operating liabilities. Operating assets are, or most common operating assets are intangible assets, whether it is patents, trademarks, copyrights, goodwill, trade secrets, prepay expense, expense that a company incur for goods and service that has paid for but will receive, such as premium insurance, like health for medical coverage, life, disability, liabilities such as lawsuits, uh, long-term care, home healthcare, nurse healthcare, home, your vehicle, uh, marketing, which is another prepaid expense, rent, office supplies, software license, maintenance contract, another operating activities or another operating assets in investment in affiliates like joint ventures, such as Crocs and Post Malone recently, equity investment, for example, Berkshire Hathaway, which is led by Warren Buffett, in which is a holding company that invests primarily in a variety of sectors like industry, real estate, energy. SoftBank, which is a Japanese conglomerate that invests primarily in technology companies such as WeWork, Uber Eats, Uber, Airbnb, Alphabet, the parent Google company that invests primarily in technology companies through its venture capital arm, like for example, Calico is one of those companies. That company focuses on longevity. Texas Pacific Groups, which is a private equity that invests primarily in uh, real estate, healthcare, cash and cash equivalent, which is another operating, uh, which is another common operating assets. So you have here like money market funds, where now this is for companies that want fast liquidity, and these funds in they purchase, so they rely on the purchase and sale of very short-term debt financial instruments such as bank acceptance, very short-term debt issued by banks, certificate of deposit, very short-term, in this case is saving certificate with very short-term maturity, commercial papers, risky corporate debt, very short-term risky corporate debt, and repo, repurchase agreement, which are very short-term debt issued by government. So once you look at all of these common operating assets and the common operating liabilities, which is part of the operating activities. In there we have accounts payable, money that you own to the suppliers and vendors, accrue expense, money that company incur for good and service that has been received but not yet paid for, such as marketing, rent, rent, utility bills, salary administrative, salary or wage, uh, taxes, deferred revenue, which are obligations that a company has to provide good and service uh, based on money that has been collected, such as subscription service or subscription service, um, Jesus, subscription service, gift cards, which is another example. Uh, Income taxes payable, such as corporate debt, withholding taxes, which this is when an employee deducts from the gross employee salary a portion and pays directly to the government. This is to promote the pay as you earn system or the pay as you earn tax system and fight tax evasion. So I also look at the sales taxes, whether it's by states or county, um, VAT, value added tax, which is a tax imposed at every stage of the production of good and service, where the customer ultimately pay the full VAT, but business along the supply chain remit that portion to the tax. Excise tax as well, which is specific tax imposed on certain goods like tobacco, alcohol, guns, gasoline. And GST, which is this good and service tax imposed on the VAT in places like Canada, India, and Australia. So the whole point of looking at that is uh, also I saw the short-term borrowings, okay, such as bank loans, line of credit, uh, commercial papers or bonds, trade credits, which is now when a company renegotiate, it is repayments schedule to their suppliers and vendors. So outstanding invoice is another way to get these short-term borrowings from a lender based on the value of your invoice, as well as payroll advance. But this is now for the company where it provides a payroll advance, or this advance to employers that will be deducted in the next payday, as well as the notes payable, which is something that I wasn't very aware of that, but it's also very important to know, because this is an agreement between the borrower that create this temporary note to the lender, outline all the terms and conditions of that loan. So instead of being a short-term loan, right, this is a long-term or based on the terms and conditions of that agreement. So here we have banks Okay, so anytime we ask a bank a loan for a bank, we automatically generating, or the bank automatically generate this notes payable. Okay, outlying is the principal, the interest, as well as the repayment schedule and some other details. So bank loans. From business, where now company, instead of going to banks, it goes to financial institutions such as private equity, venture capital, uh, also bonds, or in this case, bonds create these notes payable from government or companies. Trades payable, which now, in some case, some companies decide to renegotiate its repayment schedule to their suppliers and vendors if they have trust in there. So then I also look at how do you call it? Mhm. uh, Notes payable directly. Okay, so this is when a company address directly to a individual or a company to ask for a loan, so it generates this notes payable. So then I also look at the warranty obligations, where are obligations that a company has to fix or replace a defective product or a product that doesn't meet certain quality standards. Okay, so you have warranty or manufacturing warranties from service, uh, software, parts, vehicles, homes. So this is the most common operating liabilities. Okay, and to me, something interesting with this notes payable, that actually exists, and uh, I didn't know at least the most common example of that. But so with that, which is under the umbrella of operating activities, so that's what this first part of the cash flow statement do, right? And the way it does this, the way it do this is by first look at the net income and conciliate with any non-cash items. So items that affect the income statements, but there is no cash involved. So such as amortization and depreciations or stock-based compensations. And also it adjusts the total amount of cash that was used or perceived from other operating assets and liabilities, right? So this is the first part of this cash flow statement. And since I'm looking myself as a business, all right? So yeah, this is the way I should conduct, by the way. And then I look at the investing activities. The second part of the cash flow statement generally involve if the purchase or sale of long-term assets, meaning intangible assets, patents, trademark, goodwill, copyrights, customer relationship, uh, property, plant and equipment, investment, leaseholds improvement. And with this, okay, so for example, if a company decides to sell a trademark, so that activity will be registered as a cash inflow. Yes, a cash inflow because cash was perceived from these operations. However, if a company they decide to purchase a property to set a new location for it is, let's say, a new subsidiary, so that activity is registered as a cash outflow because cash was used for uh, that operation, which is pretty simple here. This investing activities, and then I look at the financing activities, where here in these financing activities, um, yeah, we're here in these financing activities. Investopedia mentioned that this section, so this the financial activities in the cash flow statements, focuses focus on how a company raises funds from its investors or creditors and pay it back through capital markets. So investors, this part of the cash flow statement helps investors to look at a a company and decide if it is a good investment or in this. And so this part of the cash flow statement helps investors to see where and how often a company raises funds. Okay, so how often a company raises funds and where that source came from. So if a company or the company cash flow comes most of the time from operations, so that's a good sign of an investment. However, if a company constantly rely on taking out of debt or issuing stocks, that might be not a good sign of investment. Again, there's a lot of factors involved, but most of the time that might be not a good sign of that investment. Okay, okay. So these financing activities involves the company long-term liabilities, long-term obligations, and equity. So example of this we have issuing equity, issuing stocks, paid to these creditors or paybacks to creditors. So let me look here at this one. Do, 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 do. Significant amount, significant accounting is the operating activities. I think this no long-term asset examples is here. Accounting policies, long-term liabilities, investing activities. Then you got financing activities, right? So issuing equity, issuing debt, repaying debt, which is a good sign. So if a company constantly relying on issuing equity, issuing debt, or meaning is taking out of debt, or issuing stocks or issuing equity, that might be not a good sign of a good investment. So repaying debt is good. Obtaining loans, if a company constantly paying, if a company constantly relying on this, well, it's not. Payment of dividends, repurchasing stocks, leasing. All right, so leasing is another financing activities. Leasing, repurchasing stocks, payment of dividend. Mm-hmm. Issuing equity, issuing debt. Okay. Issuing equity, issuing debt. So this is financing. This is financing examples. Okay. So if a company is, so if you're constantly as a company are issuing equity, issuing debt, that might be not a good sign of. That might be not a good. That might be not a good sign of an investment. Okay, issuing equity, issuing debt, repaying debt is another financing activities. Uh, payment, okay, repurchasing stocks, payment dividends, financing activities. So when a company distributes profits to the shareholders in the forms of cash dividends, this represents a return on the investment for the shareholders. And it is typically declared and paid by the company board of directors. By the company boards of directors. So repurchasing stocks, okay, companies sometimes buy back their own share from the open market or directly from shareholders. Exactly. So repurchasing stock is another one. Leasing. So leasing is an agreement that a company may use, a legal agreement that a company may use some property, equipment, or building uh, without taking ownership. Leasing, very common in there. Leasing, very, very common there. Okay. Leasing. So I'm looking here and I'm refreshing is most common example of financing activities. So leasing, issuing equity, issuing debt, repaying debt, payment of dividends to the payment of dividends to the shareholders, repurchasing stocks, obtaining loans. All right. So then, after that, I saw read the footnotes here, which is the significant amount. So the footnotes are packed with information, and this is some of the. Here are some highlights of this. So significant accounting policy and practice. So companies are required to disclose the accounting policy, and the policy is how the company is adhere to the accounting principles. Where here we got the GAAP, general accepted accounting principle, or the international financing reporting standard. Okay, where China and USA follows different um, financial reporting systems. The whole point of this, so GAAP is applied on the US, whereas the IFRS around the world. The whole point of this is to, or the point of this IFRS is to help investors and compare data across different companies in a consistent, honest, transparent way. Allegedly, right? Allegedly. So, for example, do you really think that most of those drug company actually follow is one of these principles? Mm? Tell me, man. Tell me. Tell me. Tell me why. So, okay, this is one of the data that are packed on the footnotes on a financial statement. Okay, so significant accounting policies and practice, because companies are required to disclose accounting policy that are most important to portray the company's financial conditions and results. And this often require managing the most difficult, subjective, and complex judgments. So this is in theory that this company must disclose the accounting policies. Okay, is the way of how they are adhering to these accounting principles, whether it's the GAAP, the General Accepted Accounts Principle on the US, or the International Financial Report, the International Financial Reporting Standard. Okay, interesting. Very, very interesting. Then I look at the income taxes. So the footnote provides detailed information about the company current and deferred income taxes. The information is broken down by level: federal, state, local, and or foreign. And the main items that affect the company effective tax rates are described. The footnote provides detailed information about the company's current and deferred income taxes. The information is broken down by level: federal, state, local, and or foreign, and the main items that affect the company effective tax rate are described. But it's the income taxes. Okay, so the footnote provides detailed information about the company's current and deferred income taxes. So deferred income taxes is a liability, because this is an obligation to pay that deferred income taxes. Exactly. It's a liability. The information is broken down by level: federal, state, and local. Pension plans and other retirement programs. The footnote discusses the company pension plans and other retirement or post-employment benefits program. The notes contain specific information about the assets and costs of this program and indicate whether and by how much the plans are over or underfunded. Pension plan and other retirement programs. The footnote discusses the company pension plans and other retirement employment. So examples of footnotes in financial statement. In financial statement. Mhm. Mhm. The footnotes. Additional information that helps explain how the company arrived at its financial statement figures. How a company arrived to its financial statement figures. I like this definition. So the footnote financial statement is how a company arrives at its financial statement figures. Interesting. Okay, so we have significant accounting policy. So some highlights of this financial or the footnote to financial statement is because it's packed with because it's packed with data that contains significant accounting policies and practice is how these companies adhere to accounting principles. Okay, so whether it's GAAP, these general accepted accounting principles on US or the international financing reporting standards. The income taxes, okay, provide more detailed information about how a company or about the company current and deferred income taxes, whether it's by state, federal, state, county, or local, and foreign. And the main items that affect the company effective tax rate are described. Pensions and plans and other retirement programs and the cost of this program. The notes contain specific information about the assets and costs of this program and indicate whether and by how much the plans are over or underfunded, and the stock options. So the notes also contain information about stock options granted to officers and employees. Mhm. Mhm. Okay. Okay. So that'll be all for this video. Take care. Bye bye.